What is a carry trade? Why is so much money in what's called the yen carry trade? And why is everybody saying that the unwind of this yen carry trade is what is currently crashing the markets? I'm about to answer all of that and explain it extremely simply because, quite honestly, everybody else's explanation of what's going on right now sucks. So number one, what is a carry trade? A carry trade is very simply where you borrow one currency that has a low interest rate for borrowing. You use that to buy another currency that has a high interest rate for holding. This is a very specific type of relative value or arbitrage trade. And if you've been around this channel for any length of time, you know that relative value or arbitrage trades are pretty much always the things that take out the markets when they grow too big from too much leverage and then people get wiped out. To use a personal finance example, let's imagine you want to buy a rental property. You're going to go to the bank, you're going to borrow dollars at, let's say, 7%, and your mortgage payment is going to be, let's say, $3,000 per month. You're going to take those dollars that you borrowed, use them to buy a property. You'll place a tenant in that property. And let's say you're going to collect $3,200 a month in rent. And I know that's a bad deal, and I'm using that example on purpose, and you'll see why later. You're going to collect that $3,200 per month. You'll take $3,000, pay off your mortgage, and you'll be left with the $200 left over. You have borrowed a currency. In other words, you shorted it because you borrowed a currency and you used it to buy something else. That is the definition of shorting anything. You borrow it, use it to buy something else. So you borrowed dollars, used it to buy a property that you placed a tenant in, and you are getting more income from the thing that you bought than it costs to borrow the dollars in the first place. Now, this is an arbitrage play, but it's not technically a carry trade because a carry trade involves two currencies. In this example, we just have one currency, but you understand the mechanics now, the concepts, what's actually going on. And the reason why I used such close dollar amounts here, borrowing at $3,000 a month and receiving $3,200 a month in income, is because that's what's going on here. We have a very small difference. Because of that, we have to use a ton of leverage. We're not just going to do this with one property. We're going to do this with a ton of properties. And we're not just going to do this with 30% down or 20% down. We're going to do this with 10, 5, 1% down because we need to get a ton of leverage so the little bit of money that we have can go a really long way. Then it doesn't matter if we're only collecting $200 per property. We have hundreds or thousands of properties, even though we started off with a very small dollar amount. Okay, so you understand the mechanics. Let's talk about the actual yen carry trade now. Step one, you're a money manager. You're an institution, you're a large hedge fund. You've got some money that you need to put to work. So you're going to go over to Japan because for years, Japan has held interest rates extremely low, which means you can borrow yen for, let's say, 1%. That's much better than you can get by borrowing dollars or borrowing pounds. And so globally, the yen has been the currency to borrow because it is so cheap to do so. So once you borrow those yen, you're not just going to hold them and pay the interest. You have to do something with all that money. So step two, you're going to exchange the yen for dollars. You're going to do it at the current exchange rate. In the back of your mind, you're thinking, well, this by itself is a great trade because usually over a long-term time horizon, the yen gets weaker compared to the dollar, which means it takes less and less dollars to get the same amount of yen. And so today, if I take all my yen that I just borrowed, exchange them for dollars, if I wanted to, I could just sit on that. And then in a couple of months, in a couple of years, I can switch them back. I would have dollars left over, and then I would still have enough yen to pay back my loan because the yen would go down compared to dollars. So that's what you're thinking in the back of your mind. Worst case scenario, even if I'm not going to invest this, I can always make money on the relative value of the yen versus the dollar. But again, you're not going to just stop there. You're going to go to step three, which is taking your US dollars that you just got by exchanging your borrowed yen for dollars. You're going to take those dollars and you're going to buy an asset in the United States with that. Now, a safer asset would be something like putting it in a money market fund, buying T-bills, buying long-term US treasuries, because those are going to give you the safe, predictable return so that you can use that income to make your debt service payments. If you put it in a money market, you're going to get 5%. If you put it in a 2-year, a 10-year, a 20, 30-year US treasury, you're going to get somewhere between 4 and 5%. So that would be a safe, predictable stream of income for you to be able to take from your dollar assets and use some of that to pay the 1% that you owe on the yen that you borrow. If you're tracking here, you're making 5% on your dollar assets, you're paying 1% on your yen liability, that debt in yen, which means you're going to take home a free 4%. You're looking at this as a risk-free trade. You're able to get 5% guaranteed, take some of that to pay the 1% that you owe on the loan, and you walk away with 4%. Because it's risk-free, you are going to do this as much as you can. You are going to borrow up to your eyeballs in yen because you are printing free money. And most importantly, it's not a huge percentage of income that you're making. And so you are going to have to load up to your eyeballs with leverage, or else the total dollar amount you're making just won't be worth it. You're gonna have to use a lot of leverage. That way, that 4% is meaningful on your money. And meanwhile, the deal on this continues to sweeten because the dollar continues to get stronger versus the yen. As more and more money around the world looks at this trade and realizes how profitable it can be, everybody does the same thing. Everybody goes to borrow yen. Remember, this is the same thing as shorting, so that pushes the value of the yen down. They use that to go buy dollars. That pushes the value of the dollar up. That means everybody participating in this trade gets to participate in making the trade work for everybody else. It's the flywheel that just keeps on rolling. That is, until it stops working. And this is why you'll see it has bled over into the stock market instead of just affecting currency markets and bond markets. And I think it's important to note here that the trigger that causes this trade to stop working and to start being unwound does not matter. In retrospect, it's always clear. Beforehand, nobody ever knows what the trigger will be. The reality is, though, many people have been warning for years about the risks associated with trades like this. It is not a black swan. I'll get to that later. A few things have happened over the last couple of weeks. Number one, the market has become more and more convinced that the Federal Reserve will be cutting interest rates. Number two, Bank of Japan raised interest rates. What happens to a currency when a central bank raises interest rates? The currency gets stronger. What happens to a currency when the central bank cuts interest rates? The currency gets weaker. So instead of the Japanese yen getting weaker versus the dollar and the dollar getting stronger versus the yen, that trend, at least for the short term, reversed, primarily triggered by the central banks doing the opposite of what they have been for a while. This pushes the yen stronger versus the dollar, which is the opposite of what you need if you're in this carry trade. Now, the difference in interest rates has changed, but that's not the real deal breaker because you can still get 3 or 4% with US dollar assets, and you're still gonna pay, even if you pay 2% on your yen loans, you're still making money there. So that's not the real problem. The real problem is the change in the directions of the currencies compared to each other. Because remember, you used a ton of leverage on this position. You borrowed a bunch of yen. You used that to buy a bunch of dollars, which means that now that the currency pair has started to go the opposite way, many funds do not have enough dollar assets in the things like the safe investments, like the bonds that they bought, in order to cover all of the yen that they borrowed. For example, if you borrowed 1 billion yen, exchanged that for dollars, bought a bunch of assets, now the currencies have moved, you sell your assets, try and convert them back into yen, you might only have 900 million yen. This means that traders and institutions and funds are getting margin called all around the world because suddenly they don't have enough assets to cover their liabilities, which means they have to tap into the other things like stocks in order to cover the difference. Now, here's the real kicker. Many of these funds, a lot of this money around the world that has been participating in this trade was not strictly doing it the safe way. Even though it wasn't safe, they were not just doing it the safe way. They weren't buying US bonds, US Treasury bonds. Instead, they were using that borrowed money to buy US stocks because the return was better. If everybody's participating in this run-up, you throw that money into the Magnificent Seven, you're getting double-digit returns. This is absolutely a money printer. Why wouldn't we continue doing this? Well, the answer is because it could go the other way. So now you're selling stocks at a loss in order to get dollars that are now not enough to cover the loan in yen that you have to pay back. Meanwhile, as you unwind your portfolio of this trade, you are buying yen and you are selling dollars. That drives them even further in the red for everybody else who hasn't yet closed out, which means that everybody else is starting to get margin called, meaning they're going to have to start closing out, and that makes the red worse everywhere else. This is why it bleeds over into seemingly unrelated assets like the S&P 500 or like tech stocks, because a few players that do have assets in those areas are having to sell those because they're getting liquidated. Mark my words, within the next couple of weeks to couple of months, there will be plenty of funds that get completely wiped out and destroyed from this. And they're going to claim this was a black swan, but it was not a black swan. A black swan, if you've read Black Swan by Nassim Nicholas Taleb, and other people have explained this as well, it is something that you think cannot exist because you've never seen it happen before. That's the idea behind the black swan, is that every swan that every person had ever seen on Earth was a white swan, so people thought black swans were impossible until one day somebody found, hey, that's a swan and it's black. Who would have thought? It's because you thought it was impossible because there was no evidence that it ever happened before. That's a black swan risk type of event. It's something that has never happened that people think is basically impossible. That is not what happened here. Going back all the way to 1999 and the collapse of long-term capital management, every single big financial event that threatens to liquidate hedge funds, unwind big trades, leverage gets destroyed, traders get wiped out, potentially threatening to knock over the global financial system, it always comes down to trades like this, to investments like this, that get too big from leverage because people thought it was risk-free, and it wasn't, so it blows up. This is what's called a gray rhino type of event, because gray rhinos, it's like every rhino is gray. Now, the thing about rhinos being gray is in the wild, it works pretty well as camouflage, but they're still gray. So number one, you're not really sure where they are. If you're going out and looking for rhinos, you know they're gray, but it still works pretty well as camouflage. You can't really see all of them though, but you know that rhinos are gray. The other thing is there's lots of them and you don't know which one is gonna come barreling towards you. So you know the risks are out there. You don't know how many of them there are. You don't know exactly where they are, but you know at some point you're probably gonna find one. That's what this type of risk was. Now, to make matters worse, this has also spilled over into volatility markets. If you've been watching the VIX, it is hit the third highest levels in history for the VIX. That is not going to happen from a 9% drop in the stock market, which is how much it has dropped by so far, leading to that massive spike in the VIX. That is because of the unwind of the short volatility trade. I've made plenty of videos about that. You can go back and find those if you'd like, but people have been shorting volatility because again, it has been working and it works until it doesn't. And once it doesn't, you get closed out, and your closing out makes everybody else's losses worse, means they close out. That's what's going on with the spike in the VIX. The unlimited money printer of shorting volatility works until it blows up in your face and wipes you out. That is another spill on, a domino effect, a knock-on effect of this yen carry trade being unwound. Now, in just 8 days, I'm going to be hosting a live free masterclass on how to profit from events just like this. Within just the last few months, I've taken home profits of 5 to 10x by trading events that are volatile just like this. In fact, just last Friday, I had a trade on the VIX that I profited 733% on. That's enough to turn a starting stake of about $500 into $3,500. I'm going to be sharing everything I know about setting up asymmetric trades just like these. Spots are limited, so sign up before it's too late with the link in the description below. Really looking forward to it. I'll see you there. As always, thanks so much for watching. Have a great day.